What is going on, you guys, and welcome back to the channel. Today we are talking about the company Empire Company Limited. It trades under the ticker EMP.A, and they're currently yielding a 1.79% dividend. And in this video, I want to share with you guys the research that I've done over the past week on whether this is a good Canadian dividend stock to buy. I actually have to give a quick shout out over to a fellow named Nell over on Blossom. He's the one that brought this to my attention. We had a nice little chat over there about this stock. And this was a new one to my radar. And I said, you know what? I think I want to do a video. I want to do a little bit of a dive and see whether this is good, because there's some interesting stuff going on with this company. If you guys haven't checked out Blossom, by the way, go down to the description and go click it and download it for completely free. There's over 6,000 Canadians on that app right now, talking stock, having these rich, fun conversations. It's really a cool place. I'm finding myself on there every single day, and I really think you guys would enjoy it. So do check it out. But yeah, thank you, Nell, for the suggestion. Let's dive on into the video. And I'll pop up on the screen just to look at the stock quote. So today's shares are trading at about $36.90 Canadian. This trades on the TSX. On a one-year number, we have seen this come down. I mean, on the one-year number, it's not too bad. It's actually essentially flat, but off highs, they're down about 18%. And let's backtrack for a second. Let's start with an overview, because this is not so much a household name. If you saw Empire Company Limited, you'd probably be like, what the heck does this company do? Empires, right? Is it a... Yeah, you probably don't know. Empire Company Limited is the parent company of Sobeys Inc. Now, when I throw out the name Sobeys Inc., I'm sure all of us across Canada know what we're looking at in terms of the type of company this is. This is a company that is based and headquartered out of Nova Scotia. FYI, they employ about 130,000 people. Their main business, it goes without saying, is in the food retailing space. Now, they do also have exposure and investments in real estate. So they own a 41% stake in a REIT called Crombie REIT, as well as similar 40%-ish stake in Genstar Capital. We've actually seen this and covered this on the channel with a couple of other companies that do have a play on REITs and real estate exposure. Nevertheless, when I think of Empire Company Limited and what I want you to think about this company, you're gonna know them best for their various chains and stores they operate as food retailing. So Thrifty Foods, Freshco being kind of one that I find just popping up all around my areas. Not so sure about you guys. Sobeys, an obvious one. We actually don't have Sobeys here in BC, or I shouldn't say BC, but in Vancouver, I don't see them. Safeway, obviously a huge one, as well chains like IGA, just to name a few. They do also have a private label brand under the brand Compliments. So you'll see Compliments products, basically all types of products you can get, as well one called Panache, which I haven't quite heard about. It's got a nice purple little logo here. But in total, they have about 1,600 retailers across basically all 10 provinces here in Canada. It's a big chain. I'm sure you guys are all well familiar with it at this point. Now, I want to start off by kind of comparing this up to its peers. Its competitors, the obvious ones would be ones like Loblaws. Okay, Loblaws comes in with a $38.3 billion market cap. This is kind of the big boy, big player in the space. There's a company called George Weston, which I wasn't all too familiar with, but this is the second largest at $24.3 billion. Metro being another major food retailing chain, $17.5 billion in market cap. Then we have slotted in here Empire Company Limited, kind of the smaller one of the bunch at a $9.5 billion market cap. I like to kind of look and preface with that, because it gives us a little bit of insight in terms of size and dominance within the market. Nevertheless, Empire is one of the smaller bunches. And in terms of performance, this has flat out been a laggard amongst these peers. So this is a 10-year chart that you're looking at, and it's essentially coming in at the very bottom, an 84% return versus, for example, a Metro, which has crushed that performance over a 10-year period. Loblaws obviously has done significantly better at 191%. Even if we shorten that time frame and look down on a one-year period, and this is really what I found was fascinating, FYI. So why I thought this stock was worth even diving into was actually this chart right here. On a one-year period, all of the food grocers have held up very well. George Weston up 22%. Loblaws up 19, 20%, Metro up 11%. And granted, this is during a stock market downturn when the markets are down and everything else is crashing and tech is down 40%. Well, these stocks have actually posted a positive return. Well, even on a one-year return, Empire Company has been the weaker performer of the bunch, down -2%, which again isn't terrible at the end of the day, but in comparison, it's just fascinating. It is a standout. And I kind of questioned why. And that's what I want to share with you. And I think if I had to pinpoint my opinion on this, why the stock has been so poor, not so poor, but relatively poor, I think that the recessionary pressures are specifically hurting this company because yes, we could argue food is a necessity. Getting groceries, going out, that is a staple in our life. Good times, bad times, everybody needs to eat. But when I popped up those brands on the page for you, a lot of these are premium brand chains, right? And I think about Safeway. When I grew up, Safeway was always where we shopped. I think it was just because it was across the road. And, my dad always took us to Safeway. And that's just what I knew. And I actually didn't really ever go to these discount brokerages like a No Frills or even a Superstore for that matter. Now that I'm a little bit older, you really start to realize how drastic the difference is in stores. I mean, price, you're looking at everything a little bit slightly marked up. Obviously, the stores are very different and contrasting in the how nice they are. And Safeways are always nicely lit in. They have a beautiful deli section. And it's a nice, fun experience, no doubt, compared to these discount brokerages, which in many cases are like bare bones, right? Bare bones signage, bare bones stocking. It's not necessarily meant to be the most prettiest of things, but they are able to get those costs down. And I think with the recessionary pressure that we are feeling right now in our economy, I mean, I know personally, I don't shop at Safeway anymore myself. Like, unless I really want to get some like nice cheese or something, like there's something I know that I want, then I'll go to Safeway. But in general, I would much prefer to go to maybe a fresh, not always. So sometimes I found at Freshco and these discount brokers, like the veggies are a little bit worse personally, but Superstore, Freshco, and No Frills, I don't think I speak for myself when there are a lot of people that have actively made that decision to say, I'm going to go save, $1 on this bottle of ranch, or I'm going to go save on these mac and cheese and go shop at a discount broker. They just make more sense. And with tighter times, I think because this company only operates one technical discount brokerage, which would be Freshco, which is again a fascinating one. This is like literally their only, brand that would fall in this category. I think that is actually hurting the company. Now, you guys can let me know down below if that is the case or not with you guys as well, if you've personally made that transition or what you prefer to go to. But yeah, that would be my first point as to why it has been a lagger. And I did a little bit of look into the profit margins. This was something else I found very fascinating. On the screen, what you're looking at is a breakdown of gross profit margin, which we have up at the top. Towards the bottom part of this page, we have it broken down by net income margin. And one thing that just jumps out to me right off the bat, you take a look at these numbers, 2, 3, 4% across the board. This isn't even really a company specific thing to Empire, but just industry. The type of field they play at is these very, very razor small margins, very, very tight in that sense. And actually what I find fascinating about this is if we look up at the gross margin, this is what kind of puzzled me a little bit. We see Loblaws posting the highest gross margin at 31.47%. Coming in second, we have EMP at 25%, and then we have Metro coming in at 20%. Now, I was under the assumption, and this is just me, prior to looking at this caught me off guard when I looked at it. I would have assumed personally, and clearly incorrectly so, that EMP would boast the highest margins. I thought one of the things that a company would have in its favor is when you have a store like a Safeway, or when you're selling more of a premium price to a bottle of ranch or to a thing of bacon bits, if you're able to charge more, I was under the assumption that that would actually help boost your margins versus like, let's say a low-cost retailer, which are essentially trying to compete or race to the bottom on pricing. Now, clearly this data shows that that is not the case. Loblaw is actually boasting the gross profit, and keep in mind, gross profit, this doesn't factor in things like, the beautiful stores and the cost of employees and the butchers and the delis. That's more operating margin type deal. This is literally like the cost of like the sale of a product, right? And if you guys know the answer to this, I would love for you guys to enlighten me down in the comment section below, because it did kind of throw me for a loop. I kind of stared at this. I looked at my various research sources and I couldn't quite pinpoint why it was. My best guess, if I had to say, is that this possibly comes down to an economies of scale thing. Because, I mean, if you look at this company, they have 1,600 retailers. And as I talked about, this is the smallest market cap relative to its peers. If you looked at a company like Loblaws, I believe they have over 2,400 or 2,500 locations. So not quite double, but they have more stores. They're pushing more volume. And the explanation in my mind very likely could come down to the fact that if Sobeys is going to be ordering, 10,000 bottles of ranch. They're at such and such price. Maybe when the volume is significantly higher and there is a bigger company and the volume is larger, they get better pricing on that. I'm not entirely sure, and I'm sure some of you guys know the answer to that. So that's what I'd love for you guys to leave a comment down below as to why. But I did find that very puzzling. Nevertheless, for this entire industry, we look at these margins, and that's just something that we have to consider, because to transfer over on into their financials, the company does make a lot of money, right? They did $30.8 billion in annual revenue. In the recent quarter, they did $7.64 billion. So they're pushing a lot of sales. And what I like about this chart, this is dating back to 2002, 2003, we do see a nice steady growth trend. This is the direction that we like to see things moving in. But as we just touched on, due to those razor thin margins, basically a long-term average being at about 2 to 3%, that translates over to a much more underwhelming amount of income. They are absolutely a profitable company, but in the latest quarter, they pulled in $189 million. So it doesn't sound all too spectacular when you look at it that way. Now, this company is expected to grow and continue this growth chart in terms of revenue, not by a whole lot. They're expected to grow revenue at about 2% over the next couple of years, which is in line with the industry. This is not a fast-growing industry, far from it. But they are well below the general market growth. And again, that's just more or less a play on the food sector business. I want to transition over to the dividend, because the dividend, in my opinion, is a highlight for this company. I would very much consider this a dividend play. This is not your typical growth stock out of the market, but it's decent. Today sitting at 1.7, 1.8%. They have an annual payout of 66 cents per year, and they do have a very decent growth rate. They've been growing it over the past 5 years at 9% compounded, which is awesome. A few good years of growth under the belt. And what I like about this is whether we're looking at a payout ratio at 22% or a free cash flow payout ratio at 15%, these are both very nice in terms of the sustainability. Another way to look at this, which may just visualize it a little bit better for you guys when we're talking about how safe this dividend is that even in some of their weaker periods, I'm just looking back to a period such as 2017 here on the bottom green bar chart, we see their free cash flow came in at $247 million. And this is, again, one of the worst years that they had over the past number of years. Well, they paid out $111 million in dividends. They still have ample coverage, nearly double the cash flow to cover that. Clearly, if we were to look over to the right side of the page, they pulled in $1.4 billion in free cash flow, and the dividend sits at $156 million. And that's where you get that number of a 15% free cash flow payout ratio. So ample coverage in the dividend. And as well, they have been growing it decently well. Now, this stock does trade at a somewhat attractive PE when compared against the peers. If we're looking at strictly from a valuation standpoint, Metro coming in at 20, Loblaws coming in at 18, and Empire at 12. And without a doubt, I could see the case where investors are therefore drawn into the stock, seeing that it is quite a value. The question that I would ask to kind of summarize my thoughts is there a reason that the PE is significantly less? Now, again, the stock is obviously sold off, but are people valuing this stock maybe subpar to a Loblaws or even to a Metro? I think Loblaws has done a very, very skookum job at establishing itself as this go-to retailer across Canada at the end of the day. The talk that we had earlier about the no discount retailers and the recessionary pressures impacting a company like this, that's something that I personally take very much into consideration. If I look at the direction of where we are going as consumers, even when times are greater and we're kind of getting out of this economic slump, I still think there is a very high demand and priority for these low-cost discount retailers. We just need food at the end of the day, and we're seeing so many people make this transition. And I think that that is actually something that this company does not have working in its favor. Yes, they have Freshco, and Freshco is great, but in comparison to other companies where you have the no frills, even a Costco for that matter. I am a shareholder of Costco, and although you have your big bulk bills, like you end up paying $200, $300, $400, $500 for one Costco run, you are resting assured that you are getting better pricing on your food. And I think that's a trend that is only going to amplify with time, which does not work well in Empire Company's favor. At the end of the day, I think you are paying a fair price on this stock. I think you do have a safe dividend. If this is one that you absolutely like because you shop at these stores and you want to support, I don't think the stock is grossly overvalued. I don't think it's grossly undervalued. I think it's fair now that the stock is down 20% off highs. I think you would pull in a very, very suitable dividend. But in my personal opinion, am I going to be buying the stock after doing my research? It's just not enticing enough for me to say that I would pick this stock over, for example, a Loblaws. At the end of the day, I look at a various sector, whether it be food retailing, whether it be technology or banks, whatever, and I want to pick the cream of the crop. I want to pick the best ones. And in my personal opinion, you can feel free to agree or disagree. I don't know why we would look past a company like Loblaws to go into a premium priced grocery company like this with premium priced stores, given everything that we talked about today. The sluggish growth, the business model, I believe, not necessarily working in its favor, and then you just have these skookum options elsewhere. I personally would be picking Loblaws over this, even with the 20% drop. But that's just my personal opinion. I did just want to share my research with you guys. I know you guys love stocks to buy, but I think it's important as well to, as you do your research, you don't just buy every stock that comes across your radar. You have to do your digging, you have to do your research. And this is one of those cases where I think it's a very fair dividend. If you love this and you like the growth, fair, but it's just not a screaming buy, one that really jumps out to me in my personal opinion. But hey, that is my thoughts for the video today, guys. I hope you enjoyed. If you like these videos, let me know down in the comments section below. Let me know what your thoughts are on anything that we talked about today. If you did enjoy, please do take a moment and drop a thumbs up. Make sure you're subscribed if you're new to the channel and you like learning about stock market, investing, different Canadian companies, especially dividend companies. Hit that subscribe button. And of course, as always, feel free to check out the Investing Academy. If you want to learn more about this stuff, if you're new to the stock market, if you want to be a DIY investor and you need a little bit of support, education, training, click that first link down below to learn about our programs. We teach people all across the country from the ground up. I don't know what a stock is. I don't know what a dividend is. I don't know what an ETF is. We can help hold your hand and guide you all the way through. And we'd love for you to check that out if you are interested. That is that first link down below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.